Hi everyone, welcome back to Commerce Student. Today in this video, we will understand the remaining accounting concepts. In my previous videos, we covered the basics and discussed various concepts. If you have not watched them yet, you can find their links in the description below. Now let's get started. Matching concept. Under matching concept, all the expenses made during a specific accounting period has to be matched with the revenues recognized in that period. That is, if revenue is recognized on all goods sold during a period, say 1 year, then cost of those goods sold should also be charged to that period. This is done in order to know the profit or loss for that period. If revenue exceeds expense, it is called a profit or income, and in case expense exceeds revenue, it becomes loss. The matching concept implies that in order to understand a business's profits, you should match the revenues earned in an accounting period with the expenses incurred in the same period. For example, salary paid in January 2024 relating to December 2023 should be treated as the expense for the year 2023 and not 2024. This ensures that financial statements accurately show how profitable the business was during that time period. Next, accrual concept. This concept tells us when to recognize revenues as well as expenses in financial statements. It states that revenues and expenses are recognized when they occur or accrue, and not when cash is either received or paid. So revenues are recognized when they are earned, that is when goods or services are sold, and expenses are recognized when they are incurred, that is when goods are consumed or services are received, regardless of cash flow timing. Let's consider an example to understand this concept better. Suppose a company sells goods on credit to a customer on 1st March. As per accrual concept, the company will recognize the revenue at the time of sale of goods, even though the cash payment is received later, say 10th March. So revenue is recorded on 1st March in the books by passing a journal entry, that is debiting customer account and crediting sales account. This is because the company has earned the revenue by delivering the goods and is liable to receive its payment in the future. Next, objective evidence concept. This concept requires that accounting transactions should be recorded in an objective manner that is free from the personal bias or judgments of either management or the accountant who prepares the accounts. It is possible only when the accounting information which is to be recorded is supported by verifiable documents and vouchers such as cash memos, invoices, receipts, sales bill, pay-in slip, etc. The purpose of this concept is to ensure accuracy and reliability of financial information presented in financial statements such as profit and loss account, balance sheet, etc. And it helps us to prevent frauds, errors, and misrepresentation of financial data. For example, when a company purchases goods from a supplier, the transaction must be supported by a purchase invoice issued by the supplier. This invoice acts as a documentary evidence in support of a transaction. That's all for today's video. If you found it useful, give it a like, share it with others, and please subscribe to my channel. Press the bell icon for future notifications. Until next time, keep learning and growing. See you in next video.